Now let's turn to the lifespan managed portfolios, and just talk about some of the changes we've made and how we're positioned. Some of the changes we've made over the last 3 months, that is. Generally, the portfolios remain fairly conservatively positioned, and we've only made a few small changes since February. In the strategic portfolios, we made a couple of changes in March. We sold a decent amount of our duration holding. So we took the view that there was some risk of yields going up, and we wanted to reduce our holding and be a little bit underweight. We also feel, as we discussed earlier, that there's probably better value in credit, and better value being with a manager that will trade what's happening around duration and high quality credit and cash. So we moved a decent holding out of our JCB Active Bond Fund, which basically invests in Australian government bonds with duration. They've got like an average duration of about 5 years. And we moved that into the Janus Henderson Tactical Income Fund. I think we put a little bit in some of the portfolios into perpetual credit fund, or it's diversified fixed income fund, which is basically a floating rate credit. But the Janus Henderson fund has a very low duration, so it's positioned to be not too sensitive on interest rate movements. And we've had both funds in the portfolio for a long time. We know what they do. We know they're very high quality managers. And so that was us essentially moving a bit of money out of duration into an environment that's less interest rate sensitive and is going to be actively managed in that space. Because of some of the concerns we had around inflation causing bond yields to increase, and some of the other factors that we've discussed today. We're also looking for a way to increase growth, but without adding to equities now. And we did that basically by adding to G-REITs, which is basically listed global property. We used an index fund for this because we're still evaluating an active manager to put in there. So probably over time, over the next month or two, we'll probably replace that manager for an active manager. It is quite an interesting asset class, and there's a lot of different managers that manage in a different way. So it's taken us a bit of time just to evaluate everything that's out there. There's also some new players coming to market. So we'll probably look at making that change over the next couple of months. On the tactical side, in February, we actually reduced exposure to duration a bit in the tactical portfolios, and we also reduced cash. Thinking was very much the same. We wanted to move money out of duration and we moved into the Janus Henderson fund as well. Same rationale as to what I said earlier. I wanted to reduce duration given the risks that I mentioned before, and move it to a tactical fund with less duration. Then in March, we also increased. Now, if you recall, we're quite significantly underweight equities in tactical. We're also underweight in strategic, but not as much. So we took the opportunity of there being a bit of a sell-off in March to reduce our underweight position or increase equity slightly, but we're remaining an underweight position during the sell-off that occurred in March and April. But as I said earlier, we're still conservatively positioned there. But we have a view to sort of slowly bring that into line over time, depending on what happens in markets. Okay, so to summarize, we're underweight equities in both tactical and strategic. Obviously, significantly more in tactical. We're underweight duration, and we're overweight high quality credit. And some of that is through a fund that will move tactically in and out of credit. We want to, as I said earlier, we want to stay away from low quality credit in this environment. And Jonathan mentioned earlier, small cap global equity. So we've been building positions to global small and mid cap equities via they call them a SMID, small to mid cap manager over the last sort of 3 to 6 months. And again, this is on valuation grounds. During a sell-off, the textbook sort of says that small and mid caps get hit harder, but we're trying to look beyond that and also think of it more from a valuation point of view, that there is a significant difference. Plus, it adds a level of diversification to the portfolio. So that's kind of a summary of what we've done over the last 3 months and how we're positioned going forward. I feel as though we're reasonably well positioned for what's going on. We're diversified, we're underweight most risky assets, but we're not crazy underweight because there is uncertainty, and uncertainty also means it's not necessarily going to result in a significant downturn for risk assets. You've seen how quickly things can fall and how quickly they can then recover based on how circumstances change. And it's hard to predict that, but when you look at it more long term, you've got to pay attention, I think, to valuations, earnings, and structural shifts in what the market's pricing for interest rate cuts and what's more likely to happen. And we've seen, Jonathan, you've talked about this a lot. You've seen how the forecast for rate cuts has been so incredibly volatile over the last couple of years. And mostly we've had revisions, we've had expectations of lots of rate cuts, and that's been hard back to significantly less than what was originally projected. So yeah, equity markets have continued to go up right up until the recent volatility. So that's how we're positioned. Jonathan, anything you wanted to add to that, mate?
No, I not really, Eugene. I think you're right. The way in which economists and analysts revise what the Fed's going to do next has just been extraordinary. It's been one of the most volatile in terms of the way the market thinks what the market thinks the Fed's going to do next. We had 6 cuts, then 4 cuts, then no cuts, then 3 cuts, then 4 cuts. Someone told me yesterday, and I haven't had time to check it out, that Goldman's is now going for 1 rate cut in 2025. So 5 minutes ago there were 4 rate cuts. So you're absolutely right. It's bewildering. There is a lot of volatility just in what the market thinks that the central bank's going to do.
Yeah. So at times like these, when you're not sure, and it's okay to be unsure, I think we go to our best tools, which is probably diversification and quality, owning quality assets, because even if you're wrong, they're more likely to stand the test of time.